All right, it's December 13th, and the Fed meeting went extraordinarily well today, at least for mortgage rates and for housing. What's happening right now is the economy is starting to show signs of slowing down. Spoiler alert, it's been that way. I've seen those signs for months, but we're actually starting to feel it now. So what happens in that case is we're hitting the Federal Reserve's target. Remember, they said they wanted to get inflation down to 2%, and we were up to close to like 7 or 8%. And what they've done is they've slowly increased interest rates over the course of the last 2 years at this point. So the way I've been trying to describe it is it's like climbing a mountain. You don't climb a mountain straight to the top. They made little incremental changes, 0.25% here, 0.5% there, 0.25% here. And these little changes end up being a lot, and we've reached the peak. And what's happened is we're kind of just traversing across the top of the mountain now. Now, of course, they're not just going to cut rates. I saw some people saying that they think the Fed's going to cut rates 250 basis points just like that. That is not going to happen. If they did that, we would be in a bad spot. That's what happened in 2020, in March of 2020, when we were getting into the COVID situation, and they had to stabilize everything, and they cut rates overnight, which had a huge impact, right? That's what got rates into the 2s and 3s. Well, we've learned our lesson. Look at where we are today as a result of that action. It's not going to happen again. And think about it. If we use the climbing up a mountain analogy, we climb to the peak. If you jump off, you kill yourself, right? You jump off a cliff, you fall, and it's just not a good situation. So what's going to happen is we've reached the peak. We're traversing. They said we're not going to raise rates now. So we're kind of staying steady, and then they're going to start to come down the same way they went up. 0.25% down, 0.5% down, 0.25% here, 0.5% there. We'll come down steadily to make sure that we don't get put in a bad situation. Now, this is what was such a big deal about today's meeting. They said we're not going to cut rates today. Yay, that's great. They said that the last meeting too. But if you've been looking at anything on Instagram or on the news, ING, UBS, there's all these banks and hedge funds that have been saying they expect the Fed to cut rates 6 times next year. And everyone was acting like that was going to happen. But the person or the group that didn't say that was the Fed. Well, today, the Fed said they anticipate cutting rates at least 3 times next year. So what does that mean for you? Well, if you have an equity line, a home equity line of credit, once you hear the Fed cut rates, so let's say in January, they cut rates a quarter, the payment on your equity line will go down because the interest rate will go down accordingly. When the Fed increases or decreases rates, your home equity lines of credit hit instantaneously. That's an immediate impact, or it's maybe a month or 2 delay, but it's there. What about mortgage rates? Mortgage rates are starting to come down as well. So if you bought a home in October, November, December, if you worked with us, you've already gotten your mortgage review. We are making sure that you have the best rate possible. So we're looking for those refi opportunities immediately. And so far, we aren't there yet, but I think we will be there soon. If you haven't gotten a mortgage review, or if you didn't work with us last time and you want to get a mortgage review, just email me your mortgage statement. We'll build out a personalized website for you. We'll show you what your current mortgage looks like compared to what a new interest rate would look like. And then if we're there, we'll help you refinance, get that ball rolling. If you're not there yet, we now have your website built to where we can track it for you and make sure when the opportunity presents itself, you're the first to know about it. So let's say you want to buy a house. If you want to buy a house, rates are coming down, which means they will be more affordable, right? That's a good sign. We're going to see rates start to come down, which will make homes more affordable to more people. We're not going to see a huge influx of inventory. And that's an argument I've had a little bit here and there on Instagram is, well, if rates come down, home prices are going to go down because all these sellers that feel like they can't sell because the rate's too low are now going to be able to sell. Well, this is simple math. If I'm a seller and I list my house, I add one house to the market, but I'm also going to buy one house, +1 - 1 = 0. I didn't move the needle on inventory. With the amount of first-time home buyers that are coming into the market, the amount of people renting that have just been waiting for this moment to present itself where rates come down, you're going to have a lot more buyers than sellers. So to me, I think we're going to have a 2021 feel in housing. While there won't be as many transactions happening because there simply won't be as much inventory, it is going to have that same feeling. So we are going to see home prices continue to rise. Now, the argument to that is, well, Sean, if the Fed thinks that the economy is doing bad, that means we're in a recession. And recessions mean housing goes down. Look at the crash of 2008. Well, that was the only time that happened. The only time we saw home prices go down dramatically in a recession was in 2008, and that was the result of the types of mortgages that were being created back then, which do not exist. That's a whole other story I can go into. I worked at Countrywide. I saw the whole thing from the front row, but it's a totally different situation. Any other recession, home prices either stayed flat or they increased. And why would that be? Because when rates come down, more people can afford to buy, and that drives prices up. It's simply supply and demand. So, getting into the holidays, there's not going to be a whole lot of new inventory coming to market. So if you're planning on buying, make sure your approval's up to date. If you haven't gotten pre-approved yet, jump on it because you want to be ready to strike as soon as the house hits the market. We typically see more inventory start end of January, beginning of February. And I want you to be well positioned. We're helping all our clients look like cash offers. We're closing in 2 weeks or less. We've been winning in multiple offers over and over again, year over year. It's kind of my thing. I love closing quick and I love winning. So if you have any questions, comments, concerns, please let me know. I can help. But long story short, today was a fantastic day in the news for mortgage rates and for housing. When mortgage rates come down, houses become more affordable. Even if they're at a higher price, you're going to have more affordability because the cost of money is what determines affordability, the interest rate, not necessarily the cost of the house. Thank you guys so much. Let me know how I can help. I'll talk to you soon. Cheers.